Investing in bonds can be a stable way to grow your wealth while minimizing risk. However, like any investment, there are strategies to follow to ensure you don't lose money. Here is a detailed guide on how to invest in bonds without losing money. Understand the basics of bonds. Bonds are debt securities issued by governments, municipalities, or corporations to raise capital. When you buy a bond, you are essentially lending money to the issuer in exchange for regular interest payments, coupons, and the return of the principal amount at maturity. Choose high-quality bonds. Opt for bonds with high credit ratings. These are typically issued by financially stable entities and have a lower risk of default. Rating agencies like Moody's, Standard & Poor's, and Fitch provide ratings that can help you assess the creditworthiness of bond issuers. Aim for bonds rated O or A. Diversify your bond portfolio. Diversification is key to managing risk. Spread your investments across different types of bonds, such as government, corporate, and municipal bonds. This helps mitigate the impact of a single bond defaulting. Additionally, consider diversifying by maturity dates and sectors to balance your portfolio. Consider bond funds. Bond funds offer a diversified portfolio managed by professionals. They can provide exposure to a wide range of bonds, reducing the risk associated with individual bond investments. Mutual funds and exchange-traded funds are popular options for bond investors. Focus on long-term investing. Bonds are generally considered long-term investments. Avoid the temptation to trade frequently, as this can lead to losses due to market fluctuations and transaction costs. Hold your bonds until maturity to ensure you receive the full principal amount and interest payments. Monitor interest rate trends. Interest rates have a significant impact on bond prices. When interest rates rise, bond prices fall, and vice versa. Keep an eye on economic indicators and central bank policies to anticipate interest rate movements. If you expect rates to rise, consider short-term bonds, which are less sensitive to interest rate changes. Use laddering strategy. A bond ladder involves buying bonds with different maturity dates. This strategy provides a steady stream of income and reduces reinvestment risk. As each bond matures, you can reinvest the proceeds in new bonds, potentially at higher interest rates. Stay informed about economic conditions. Economic conditions can affect bond performance. Stay informed about factors such as inflation, growth, and unemployment rates. These factors can influence interest rates and the creditworthiness of bond issuers. Be mindful of inflation. Inflation erodes the purchasing power of fixed-income investments like bonds. Consider investing in inflation-protected bonds, such as Treasury inflation-protected securities, TIPS, which adjust their principal value based on inflation rates. Avoid overpaying for bonds. When buying bonds, ensure you are not overpaying. Check the bond's yield to maturity ITM and compare it with similar bonds in the market. A higher ITM generally indicates a better deal, but also consider the bond's credit rating and other factors. Maintain a long-term perspective. Investing in bonds requires patience and a long-term perspective. While short-term market fluctuations can affect bond prices, holding bonds until maturity ensures you receive the full principal and interest payments provided the issuer does not default. By following these strategies, you can invest in bonds with a reduced risk of losing money. Always conduct thorough research and consider consulting with a financial advisor to tailor your bond investments to your specific financial goals and risk tolerance.